Hello, this is Prof. Aram, and in this short video, I'm going to go over the main financial statements and how finance professionals use these financial statements on an everyday basis to make better decisions for their firms, for their institutions, or for their clients. So let's get to it. The main three financial statements that we usually focus on are the balance sheet, income statement, and the statements of cash flows. And in the future videos, I'm going to go over each of them in detail. But right now, let's look at the audience for these financial statements. These statements are used either by the management of the company, in other words, the insiders, or by the outsiders in the company. So, first of all, managers need to use these financial statements to perform three important tasks. First is to assess the financial condition of the firm. And second is to monitor and control the operations. And the third one is financial forecasting and planning. So if you don't know what's happening in the firm, if you don't monitor your performance on an everyday basis, you can't plan ahead. You can't plan ahead efficiently. So insiders of the firm look at these financial statements on an everyday basis to basically understand how the firm is performing and how they can make it better in the future. Keep in mind that the balance sheet, income statement, and statement of cash flows that managers are using are a little bit different than the ones that outsiders are using. Also, outsiders of the firm are investors, regulators, and other financial institutions such as banks and insurance companies. Almost all regulatory agencies in the US, it's Security Exchange Commission, and in the rest of the world, it's similar, require that public companies report these financial statements periodically. And the goal here is to reduce the information asymmetry that exists between the insiders and outsiders of the firm. So obviously, CEOs and CFOs usually have access to the complete information regarding the firm. But outsiders don't have that luxury. They don't know what is happening inside the firm. So in order to be able to reduce this information asymmetry and provide more information to outsiders so they can make better decisions or regulators monitor the company better, they need to provide these financial statements to outsiders of the firm. So the outsiders include, of course, the regulators such as Security Exchange Commission. Investors look at these financial statements on a regular basis to decide whether they want to invest in this company or they want to divest or sell the shares for this company. Creditors also use the information inside these financial statements to decide, for example, whether to extend credit to the company, to lend money to the company or not. So in the future videos, I'm going to go over each of these financial statements in detail. I hope you enjoyed this video and thanks for watching.